Welcome you all once again to today's section. Today we will finalize on the question that we look at it last section, and then quickly solve one more and move on. We are still at the preparation and presentation of the financial statements. Good. So let's quickly put some few stuff together for Bix. So Bix Limited. This very question. Bix Limited. Bix Limited. We have gone through this already, so we will just have to scan through this. And I believe strongly that you've gone through it after our last section. So I'm going to prepare the statement of profits or loss and other comprehensive income for the year ended 31st December 2018. Good. So let's see. So right after the reading the requirement and the exam question or on the exam's condition, the financial position as of 31st December 2018. So what do? Right after the requirement, I'll go and set the tone. But the SAT should prepare profit, loss, and other comprehensive income and the statement of financial position. What do? You set the tone for the solution. How do you set the tone? Right, the requirement first. Right after the requirement, go straight and tell the examiner that the requiring profit and loss. So this section is my profit and loss. This section is my financial position. Workings will start from third page or from the fourth page going. You are done. So maybe this page 1, this page 2. So basically outside here, that is another Bix Limited. So Bix Limited. Then instead I should prepare statements of profits or loss for the year ended 31st December 2018. Good. And I'll go and check the reporting currency. So the reporting currency from the question, I believe strongly that is what? Cedis. So let's check if it's with 3 zeros or it's in millions. Good. So it's in thousands of cedis. So I'll go and do that. So like this. Without reading anything from the footnotes, I'll start solving. I'll go to the next page. I know that my profit and loss statement maximum should take what? 13 lines. So first page to go there. I'll go to the financial position. I'll do the same. You are solving this question under exam condition. Move on to the next page, right? Bix Limited there. Bix Limited. Under exam condition. Bix Limited. Good. Then what do? Statement of what? Financial position. It's all the question. Is attempt to? You are attempting it. Financial position as at 31st what? December 2018. Your currency, Ghanaian cedis, in 3 zeros. You are done. So even if you should end here, the 3 protocols, you will score them. So right after the requirement, this is what you are supposed to do. an exam condition. Because definitely the question you solve them. So if you can do something, you do. If you cannot do anything, you move on. Then we are going by the RATS or the rough approach to solve your question. Requirement first, additional information, trial balance or the financial statement. So let's go to the footnote. You've gone through already. Just I was just come through to familiar ourselves. So note one talks about the current value of inventories at cost at 31st December 2018 was what? 39.5 million. That will go to cost of sales calculation. Great. And the financial position as what? Current assets. Then note two. On January 2018, Bix Limited sold some of its plants and equipment to a finance company. Bix Limited credited a sales proceeds of 25.6 million to revenue. Have to take it off. It's still and lease back and a finance lease. So we take it off. It's not a sale. Now let's see. The plant and equipment was purchased by Bix Limited on January 2017 at a total cost of 32 million and was being depreciated over its estimated life of what? Of 5 years. The costs and accumulated depreciation of the disposed asset is still included in the PPE cost and accumulated depreciation account. We saw that the last stage of PPE, that's derecognition, at what stage do you stop? Or during disposal of an asset, the asset details must be what? Eliminated from the books. The disposed asset must be eliminated, and here they've not done that. And I promise you that the examiner will not do that for you. You will do it. Good. So you have to take the details of cost from cost, accumulated depreciation from accumulated depreciation. They bought it when? January 2017. So we pick it and depreciate it. The cost was 32 million. So from January 2017 up to when? So on January 2018. So exactly what? Exactly 2 years or 1 year. Exactly 1 year. So 1 year depreciation must be taken off from the accumulated depreciation. We are done. Now let's go to note 2. And then the cost 2 must also taken from it. Okay, the continuation of note 1. On January 2018 Limited, on January 2018, Bix Limited began to lease the plant and equipment from the finance company on 4-year lease rental. Sorry. Let's take that again. On January 1st, 2018, Bix Limited began to lease the plant and equipment from the finance company on a 4-year lease. Lease rentals were 7.2 million payable annually in advance. If Bix Limited had borrowed funds from the finance company on January 2018, the annual interest rate would have been 8.5%. That will be the finance charge on the lease. Good. And note 3. So you calculate the finance lease, do that working, and then you'll be fine. Note 3. On January 2018, Bix Limited issued 200 million preference shares. This one we did it. We saw it, so I think we can refer to move faster. Good. We said that they issued 200 million preference shares at 32.5 pesos each. Cost of issue were 1 million, so that the net proceeds of the issue were 64 million cedis. The preference shareholders will receive an annual dividend of 30, on 31st December each year of 3.9 million. Good. The shares will be redeemed at par on 31st December 2022, that's 5 years' time. The effective annual finance costs attached to these shares is approximately 6.4%. The first annual dividend was paid on 31st December 2018 and is included in the dividend paid. The equity shareholders were paid a dividend of 4 million in the year. Note 4. Estimated income tax on the profit for the year to 31st December 2018 is 4.5 million. And then this one 2 years, we did justice to it. During the year, 4.2 million was paid in full and final settlement of income tax on profits for the year ended 31st December 2017. The statement of financial position as at 31st December 2017 had included 4.4 million in respect of this liability as a provision. Good. So we compared and we said that it has been over provided. So we take it off from the current year tax provision. At 31st December 2018, the carrying amount of the net asset of Bix Limited exceed their tax rate by what? 25.8 million. Assume a tax rate of 25%, right? Good. So we calculate the deferred tax. Now note 5. They have given us the details of the PP, costs, and then accumulated depreciation, and the current amount. All of them are there. Now they are saying that estimated, estimates of the useful life or useful economic life at the date of purchase of PP components are as follows. So the land, nil. Building, 50 years. Plant and equipment, 5 years. Good. So that is it. Now, on 30th June, this is the IFRS 5 section. On 30th June, director decided to sell the property because more suitable leasehold property had become available at a very competitive cost. They advertised the property for sale at that date at what was considered to be realistic asking price of 68 million. Good. They estimated, sorry, they estimated that cost of 3 million would be necessary in order to sell the property. So that's cost to sell. Just that on 1st December 2018, they reduced the asking price to 64.5 million and sold the property at this price shortly after the year end. Cost to sell totaling 2.5 million. We are done. Now here we picked the 64 for two reasons. One is a fair value at the end of the reporting period, and two is the is very close or the same as for the actual fair value. So that's why we selected that very figure. And then we less the 2.5, that's the value, fair value less cost to sell. Then we are done. Great. So now we know the items that are not free. The first one is sales. So we're going to pick our sales. Sales revenue is what? 184,800. We take off the note what? No, 2, 25.6 million from it. So let's start again. So first, we are done. So right after going through the footnotes, you can start. But before you start, let's go to the trial balance. So scan to the trial balance for 2 items. Scan to the trial balance for 2 items. First, usual items, just move on to unusual. Unusual, what do? You decide. So revenue is usual. Lease rental, it might be unusual for now, but after this question, it will be what? Usual. Then production cost, distribution, admin, inventory, dividend paid, income tax paid. No, 3. So they paid 37,500. Let's see, income tax. No. So 200. So this is the overtax of 200, overtax provision. PPE cost. So they show the breakdown there. Provision for depreciation, 31st December. They also show the breakdown. Trade receivable, cash and cash equivalent, trade payables, preference shared issue, deferred tax, stated capital. All of them are there. So if you scan through, none of these are new. So unusual. Let me know if these items, the treatment some way. So let's go straight to the game. So the examiner said revenue. I will write revenue here. I'm supposed to pause, go and do workings and bring it back. But I can show it like this. Tell the examiner that the revenue figure is 184,400 or so. Okay, it's 184,800. So 184,800 less note 2. Note 2 is 25.6 million. So 25.6 million. Take it from there. Great. So 25,600. Great. Answer. So what do you get? So 100 and I like that. So 159,200. That is it. If you don't want to do this, you can go and perform workings and bring it back like workings 1. If you want to do the workings 2, it's allowed. So start the workings 1. It's on revenue. So is it per the trial balance? Revenue figure is what? 184,800. So what? Less what? Leased plant or sale and lease back. So sale and lease back, 25,600. You get 159,200. So in that case, when you come here, you don't need to show working again. Just record it freely. Then you tell the examiner into brackets, working number what? 1. Please refer the examiner. This is how you want it. Good. Just that I like doing it here so that we take 184,800 less 25,600. Good. Now let's move on. Where do you go to? Cost of sales. Right here, cost of sales. For cost of sales, that one, advice, don't do it on the face, don't do it somewhere. Yes. So that's where I'll start my workings from. So please, from your fourth page going, create workings there for me. Your fourth page going, create workings. So that's where I start. So workings, clearly, workings one is on cost of sales. So cost of what? Sales. Here, if cost of sales is not given to you directly, then that means you have to start from the opening inventory, purchases or production cost, and then realize the closing inventory. Then we are done. If there's any depreciation on production equipment, you add it. Great. Okay. Now let's continue the game. So I start the cost of sales. Tell the examiner that open inventory. If cost of sales is not given to us in the question, don't forget your three zeros. Must follow you. And let's go to the question and pick the open inventory. Open inventory, why are you? The trial balance, open inventory is what? Inventory. That's 37,500. So 37,500. Yeah, let's see if you have purchases or production. A manufacturer will produce, a trader will go and do what? Buy. So that's the purchases. Buy and sell. But you have production cost. So that means this is a manufacturer. Yes. He produce what? Both local and continental dishes. That's 98,000. So production cost will come. Production costs 98,000. The less what? Closing inventory. And then you add any other direct costs. Good. Now the closing inventory was given to us in the footnotes. So when we pick it, is there, which is what? First footnote 39,500. So 39,500. Then I'll add any direct cost or adjustment. Adjustments such as what? Inventory written down, warranty provision, depreciation. Because this person, they are manufacturer, we will charge depreciation to what? Cost of sales. So let's charge depreciation to the cost of sales. Now the depreciation, you can go and do the working somewhere and bring it if it will confuse us. If it will not confuse you, just do this like this and list all the assets that need to be depreciated. Good. So all the assets that need to be depreciated, let's do the calculation here. So that's depreciation. All the assets that need to be what? Depreciated. So first, what is the first asset on the list? Good. So that is it. If I hear the assets are few, there are about three, right? Only two will be depreciated, one will not be depreciated. So let's take note. So the depreciation, we will take the one on the building, right? So let's depreciate the building first before you go to the plant. So let's go to the building. The building too, there was a sale. For last section, we calculated the depreciation. Yes, we did that. So if you do have it in your just bring it. But let's do this again. They said the building, they classified the building on 30th June as what? As held for sale. So depreciation must be charged from the date, from the beginning of the year up to the day that they do the classification. Good. Which is what 6 month depreciation before. Because if you classify a particular asset as held for sale, you see charging depreciation. Yes. So that is it. So what's the cost of the building? And what's the original depreciation values? The cost of the building was given to us as a breakdown. Cost of the building is 38,000, and then they originally last for 50 years, right? It was a 6 month depreciation. So let me throw this thing down. So it will be 38,000 all divided by 50 years times what? 6 out of 12. That'll give us 380, right? So that's the depreciation of the building before they classified it for what? For sale. Good. Okay, now let's continue the game. Now, apart from building, what are the other assets that need to be depreciated? The plant and equipment. Now, the plant, there are two types. We have the lease plant and an existing one, right? So let's calculate the depreciation different. So let's go to the existing plant first, and then let's get the lease plant. So it means that we have to take our time, go through that note again. They said that some of the plants were what? So let's see. That's the note 2. We are looking for the cost of the plant that they disposed of. Originally, it had called what 32 million, right? So that means the existing one, you have to take 32 from the entire plant. So let's take it again. On January 2018, Bix Limited sold some of its plant and equipment to a finance company. The plant, Bix Limited credited the sales proceeds of 25.6 million to revenue. Than that, the plant and equipment was purchased by what? Bix Limited on January 2017 at a total cost of what? 32. So the lease plant, the cost is what? 32 million. But we want to calculate the cost of the existing because along the line they sold it and then they what? Leased it back. Agreed. Along the line they sold it and then they leased it back. So we want to calculate the existing one because we have to affect the lease, but it's a finance lease. So 32 must be taken from the cost of the plant and equipment. So let's go. If the entire plant is 87, the entire plant is 87, and then the proportion or the section that was leased had a total cost of 32. They want to be the remaining double five, right? Good. So double five. So the 55 must be depreciated on what? 5 year period. So 5 years. Yeah, tell me how you arrive at the 55. Very important. So I write plant here without any lease. I open my bracket. I wish I can do this calculation somewhere. Let me do it here. My space, no go there. Or I can squeeze it too. Let me squeeze it. So plant, I'm doing the own one. So to be 87,000 less what? 32,000. All divided by 5 years. Agreed. or divided by 5 years. But let me continue from this section. Continuation. We are continuing from this section. So plant, open a bracket and tell the examiner that the entire plant is 87. The lease are 32. And then for how many? You go for 5 years, right? And that'll give us any answer for me. 55 divided by 5, 11. So 11,000. Now let's go to the leased plant. According to IFRS 15 leases, the asset must be depreciated over the shorter of the lease term and the asset useful life. And here the lease term and the asset useful life are the same. Lease term is 4 years. The asset will last for 4 years. Yes. In fact, that is it. So let's go and pick that very one and then depreciate it. Great. So with the lease plant, what is the cost of the lease plant and what's the lease term? What's the cost of the so what is the cost of the leased plant? Let me check it again. Good. So basically that will be so that will be 32,000 divided by 5 years to give us the same answer. Here we can try alternative. Yeah, to give us the same answer. Yeah. So what we have to do is this. For the lease plans, can tell the examiner that the cost is 32,000, the life is 5 years to give us 6,400, right? But I have alternative. I like the alternative more than this. Alternative, let's find the current amount of the lease plant. At the date of the lease, what is the current amount of the plant? The plant originally cost 32,000 and then depreciation was 5 years, so divided by 5. So current amount will be 11 4 years, right? Now let's use the shortcut approach, the one that we did under the IA 16. We said that to get the current amount is the years remaining, right? If the asset is going for 5 years, now they've used how many? 1. So left with 4 years. So 4 out of 5 times 32,000 basically gives me the current amount of the asset remaining. The current amount of the assets. That is will be 4 out of 5. That's 0.8 times what? 32. That will give me 25,600. How we get it? Good. So that's the fair value of the assets. So the current amount of the asset I've calculated with 25,600. What do? I'll now divide this one over the shorter of the lease term and what? The useful life. So which is 4 years. If I divide this one by 4 years, it must give me the same answer as this. Basically, that is it. Agreed. So this divided by 4, that's 6.4. So we select one, then you move on. Don't need to do all the two. So we are done with the cost of sales. So let's put them together and total them. So total cost of sales will be putting all this together. If you do have any question, kindly let me know. So the total cost of sales will be adding from here. Open production lines, depreciation, the three, putting them together. What will be the answer? 113,780. So 113,780. So come and put it here. 113,780. Tell the examiner that workings number one. Preferrer. That's my workings number one. For your own, it can be your workings number two, three. Then you tell the examiner. Good. So 113,780. Then we are done. Great. Now let's see the game. Let's see the game. Let's continue the game. The game is getting interesting. Okay, so with the building, they classify the building for sale. And we said that if you classify your building for sale, you don't need to depreciate it. But the asset was carried at what depreciated cost. So they changed their mind when June, ending of June. So from January up to June, depreciation must be charged. That's what 6 months. So 6 month depreciation must be charged. So that's what is charged. And then we are getting the 380. So the entire the value is 38 over 50. So by 6 out of 12 will give us the 380. Good. So that's how we arrive at what the building. Okay. Great. Now let's continue the game. So what's the gross profit? Quickly. Okay, let me take kindly be copying the workings and leave the main solution. I'll give you time to copy the main solution. So gross profits. Then I wish you can give me figures. So gross profit is what? 45420, right? Okay. From the gross profit, where do you go to? Your operating costs. Yeah, operating costs. I'm going to list all the costs together. But if there are demarcations, you have to do that. Where there are no demarcations, then you go and list all of them. Please, can I take this section off? Good. Let me do that. So let me take just this section off. Now operating cost, that's the workings number two. So workings two, operating what? Cost. Here you have to bring the admin and then sell and distribution costs together. Come and then assemble them. So any item or any figure that will go there, we bring it. If there's any note, is there any note affecting admin and distribution? If there are no notes, then that's good. That one, don't put them together. Show them on their own because nothing will affect it. Good. So that's very good. Good. So basically, that is it. Is there any note that will affect the admin and then the distribution cost? Is there any note that will affect admin and distribution cost? Great. So no notes will affect admin. So first time our admin and distribution cost is free. No notes. If there are no notes, then you don't need to show working. Then leave them like that. Let them be on its own. So I record distribution here and admin cost. Now I guess, yeah, distribution is 9,000, right? And then admin is also 20,000. You put it in brackets. You take it off, then what do you get? You get operating profit, right? And that will give us 16,420. Good. Then go to other income. Do you have other income in this question? Let's see if you do have other income in the question. So, do we have other income in the trial balance? So, income tax, provision, depreciation, no other income. So, I'll throw that here, put them together. I'll still get 16,420. That examiner, that is what we call profit before interest and tax. Now come to the interest, or call it finance cost. In fact, as soon as you are done with the operating cost, within some few minutes you finish. Finance cost, I'm going to do workings. So that's workings number 2 for this particular question. So have you seen that? But the question is not that disturbing, right? It's not that disturbing. So finance cost, that's workings number 2. Finance cost. With finance cost, we said that it includes what? The interest that you are paying on all the facility. It includes the redeemer preference shares, the dividend paid on that one. Then what again? The bank interest, and then the finance charge element of the lease. So you go and calculate that. Good, we will go and calculate that. So let's go to the question and pick the finance charge. So preference shares, that's note 3. And then the lease, that's all for this question. So for the lease, we do that. For the preferences, I think we calculated for the preferences. Good. So for preferences, we had 3.9 million, right? So for preferences, and then we calculated 6.4%. We said that is the effective interest rate that will go to the finance charge, right? Good. So what was the answer? Please, let's bring it. Okay, let's calculate it again. So we drew the amortization table. So let me just bring it. That's workings number 3. In amortization table, we told the examiner that we will start with our year. We are doing the year one. So balance brought down. Liability at the start of the year. Good. Now we charge the effective interest rate. That's what we are looking for. So the balance was 64,000. The net, the effective interest rate was 6.4%. So we charge a 6.4% on this figure. So effectively, that's it. And that will give us, so let's see, 60, 40 and 96, right? 40 and 96. Then we proceed to calculate the nominal rate. We had 3,900. We took it off to get what the closing balance. The closing balance that we had, I'll pick it to what the financial position. So take it. So over here, we'll tell the examiner that preference shares. So preference shares, dividend. Open your bracket. If you have not done this anywhere, open your brackets. Tell the examiner that is 64,000 times the 6.4%. So that this one will go off. Good. So this one will take off because you do have it there. Then 40 and 96. Then we go and calculate that one for that of the lease. For lease 2, for the lease finance charge on the lease, open your bracket. Here is in advance for okay. Now what the preference shares is a finance or a financial liability, because even though preference shares, they are shares, we are going to classify them as what? As liability. Why? Because this type of preference share is what? Redeemable. So any dividend paid, it must be treated as what? Finance charge. But here, because it's a financial liability, you have to perform the calculation and calculate and take the effective interest rate. And that one, we have to charge it on the open balance of the liability at the start, or the open balance of the liability. So we did that, and we had 4096. Good. Or basically, it's the same as the liability at the start is 64,000. Now the proceeds times the effective interest rate. So this one is times, not plus. So times effective interest rate of 6.4%. Whatever answer you get, that's what to go to the P&L. You are done. Good. Now when you go to the leased plans, a finance charge on the leased plan too, don't worry yourself. Open the brackets. Tell the examiner that the liability at the start will be the liability at the start on the finance lease for the fair value of the asset is 25,600. Agreed. Good. So what will be the liability at the start? Now the liability at the start too will be that figure. But because this lease is in advance, you have to subtract the payment. Any payment must be subtracted before you calculate the finance charge. So the fair value is what? The fair value is 25,600 less the rental charges. So what's the rental charges? So the rental charge is 7,200 according to note, yes, note 2. So I'll take it off and then charge a finance cost of what? 8.5 million, right? 8.5%, not million. Good. So less 7,200 now times 8.5%, and that will give us 1564. 1564. So therefore, the total finance charge will be 0.66, and then another 5, like this. Good. I hope you get it. Good. Okay. I hope it makes okay. So, so with the lease plans, the liability at the start of the year is 25,600, but they made advance payment of 7,200, reducing the liability at the start of the year. Hey, sorry. Great. So it will reduce the liability at the start of the year. Then you charge the 8.5% on it. Good. Then you are done. Now let's continue the game. So I'll come here, tell the examiner that, go to my workings number 2, you see the finance charge there. I'll take it off. Then what will be the answer? So 16,420 less 5660. And the answer will be good. So it should give us 20, 60, so 10,760. And then we call this one, this profit before interest and tax. So this becomes profit before tax. Profit before tax. So profit before tax. So what do? You will go and calculate your income tax. And then they have informed me that when it comes to tax, target members are superb. So you're going to do it for me. Good. So I'll just project the tax section. Then you give me the total tax liability. Total tax liability and then the expense. Please be part and calculate some. Because so with the income tax, that will be workings number 3. My working 3 is the income tax. So working 3, at least now I'm doing it. I was supposed to be posting it though to the P&L, the financial position. I will tell me that you do that. Good. So income tax. So with the income tax, just relax. We said that is a C, U, or O, and a D. If you don't want trouble, don't write it. If you don't want trouble, just write C like this. Leave empty space. I can write D. Good. Now leave space, because if you write under and happen to be over, you'll be in trouble. So yes, it's over. Good. So let's see in this question. In a trial balance, they show the income tax there. Anytime I see income tax in a trial balance, it is under or over. If it's a debit side, it's under. If it's a credit side, it's over. So this one is over by 200. So I'll go there and record over. If there are no notes, so over tax. I bring my currency, but must go top, top, top. Then I'll put my 200 Ghana here. In fact, if you go to the footnote, there was a note to that one. If I'm using the footnote, the footnote first states that the estimated income tax on profits for the year 31st December 2018 is what? 4.5 million. That's the current year tax. So I'll put 4,500 here as the current year. So I'll just add current year tax provision. Then I'll move on with the story. The examiner was talking plenty, or he made it short for us. He said, during the year, 4.2 million was paid in full and final settlement of income tax on profit for the year ended 31st December 2018 last year. So they just gave me information about under or over at 31st December 2017. The statement of financial position as at 31st December 2017 had included 4.4 million in respect of this liability. So therefore, the provision was what? 4.4. And then the great. So over provision of what? 0.2 million. That's the over provision. So which was represented in what? The trial balance. Good. Now let's see. Now let's go to deferred tax. Now when you go to deferred tax, you relax. So I have to do workings within workings. So workings number 4, I'll call it deferred tax. Deferred tax. I'll put my 3 zeros here. Tell the examiner that open balance. Then leave a space and go write closing balance. Open balance in the trial balance. If it's not there, it's not there. I cannot create any open balance. So let me go and check. If it's not there, it's not there. See? If it's not there, dash. Just leave dash there. But here there's deferred tax here of 8,000. So open balance of what? 8,000. I record it here as what? 8,000. Closing balance, they'll not give it to you. You have to find by yourself. By finding for what? The finding for oh, the temporal difference. I like that. So let's go and find for the temporal difference times the tax rate. That's the closing balance. So note 4 states that the latter part of note 4, the last one sentence, as at 31st December 2018, the carrying amount of the net asset of Biggs Limited exceeds their tax base by what? 35.8 million. So that means the temporary difference 35.8 million. Assuming income tax rate of 25%. So let's find 25%. So open your bracket. That is under that 35.8. So it will be 35,800 times 25%. And I believe strongly that it will give us something like 8,950, right? So the difference is the movement, and this must be reported towards the profit and loss account. So I write here P&L in the bracket, preferably, or the specific section that will go, it go to income tax. So the difference of what? 950, right? Agreed. Good. So we are done. When I come here, I'll just write deferred tax. Workings number 4. So workings within workings. It is 950 positive. For the overtax, it was overtax provision. So that one, let's put it in brackets. Over we subtract. And then we are done. So basically, we are done. We sum them up and then we post the entry. So therefore, adding all these, then you had it correct. Yes. So the statement that they told me is true. That the target members, when they come to income tax, they are okay. So right there, taking to what? P&L, right? So taking to P&L as income tax expense. So I'll quickly come here. That examiner that income tax expense. So income tax expense must be 5,250. I'll put in brackets, align it, and get my profit after tax. Please, this figure goes to the financial position as what? Current liability. This figure, the closing balance, goes to non-current liability because it is taxable and it ends there. The over or the under does not go anywhere apart from here, except for if they have not paid. What's the profit after tax? And that's the end of this question. The financial position, I'm expecting you to do that for me. Just articulate this one. All the closing balances that we had must go to the financial position. And then the depreciation, find the current amount of the assets, and then we are done. So I'll take your financial position. If I do one, you do one. Good. So if your financial position ready to, and also hand over. Good. So that is it. So now what's the profit after tax? Let me continue from this section. Financial position, you are going to tackle that for me. So what do we do? Yeah, we will look at profit after tax. That's antipart. Try, it's not coming. Sorry, let me step him down. So profit, yeah, this one's coming. So profit after tax will be, this was the profit after tax. You take 5,250 from 10,760, so that's 5,1. So 5,5. So 5,510. Then is another other comprehensive income. Other comprehensive income, OCI dash. So therefore, the total comprehensive income is what? No revaluation, right? Is there any revaluation or reclassification? No revaluation gain, no reclassification. So finally, we are done. So we tell the examiner that the total comprehensive income will be 5510. That is the end of the profit and loss. Promise that the next section I will record the financial position for you. Yes, I'll record the financial position for you. Great. So that is the end of today's section. We are continuing the financial position. And don't forget that sometimes we'll be required to do changes in equity. All of them are in the videos that I posted on the platform. Good. So if you do have any question, kindly ask. If not, then let's tackle another one again. I believe in economies of scale. Touching a lot of questions will help us to understand it. Because if you rely on one question, then I'm so sorry. Okay, so our next section, our next question will be a company called Quadaso Limited. Quadaso Limited. So with Quadaso Limited, let's try Quadaso Limited. Our next section, we are looking at Quadaso Limited. So let's go to Quadaso. So the examiner take me to Quadaso Limited. Let's go. Quadaso Limited. Great. Quadaso is here. Question 3. Question 3. Quadaso is 2016 November. That's Quadaso November 2016. Please, in the handout, most of the questions are not past questions, so those ones are very good for illustration. So Quadaso, wow, I like Quadaso. There's something in Quadaso that I've seen right now in the trial balance, which is very good. So here too, under exam condition, you first read the instruction or the requirement first. Now, look at what they are saying. Prepare. So we are starting the requirement. Prepare the following financial statement of Quadaso Limited for publication in accordance with what? The IFRSs. That's the International Financial Reporting Standards. Statement of profits or loss and other comprehensive income for the year ended 30th September 2015. Thank God. B. Statement of changes in equity. For the year ended 30th September 2015. And statement of financial position as at 30th September 2015. Show clearly all relevant workings. Note that accounting policy notes are not required. If required, I will not do. Accounting policy and notes. All what we need is the workings. So that's a D. So that means the examiner is looking for 4 statements from you. So the first page, second page, third page, please show all of them on its own. A different page in the exams to enhance the marking. Easy, make the marking so smooth. Good. Now that we are done, we are still following the rat approach. So let's go to the rat. On note 1, so we have the footnote or additional information. On 31st March 2015, the company made a bonus issue from retained earnings of 1 new for every 4 shares in issue. So we used to call this one 1 for 4. 1 for 4. 1 for 4. 1 for 4. Good. Now this. Okay. So now here the issue is those a bonus shares issued from where? The company's retained earnings. So here's a transfer from the retained earnings to where? The stated capital. Bonus share. And then the fair value. Here, when there's a bonus shares, you have to use the fair value of the shares. Just that here they told us that the issue is for how much? 10 Ghana cedis each. And then this transaction is yet to be what? Recorded in your books. What do? You have to record it. Good. You have to record it. This is the same question, similar one was in that year's question bank. So the question bank that you have, take it serious. Similar one was in that year, 2015 question bank. Good. Now let's continue. The second part of the note 1 states that the company paid ordinary dividend of 22 pesos. That's 2 cedis, 20 pesos per share on 31st January 2015. And again, 2.6 Ghana cedis per share on 30th June 2015. Here there's danger. Have you seen they paid two dividends? One is January, one is June. Meanwhile, they've issued shares. So they have issued shares on 31st March. So it means that some of the June dividend, it will include the new shares, right? Whilst the January dividend will not include the new shares. So that's the difference. So let me take it again. So let's go to the board. Yes. But that section is a bit crucial. It's a bit crucial. Good. Now let's see. March, they have issued shares, just that January, they pay dividend. So this dividend will be based on the open balance of the shares. Then March, they issue shares. But June, they pay dividend. So June dividend will be based on what? Shares after the issue. That is the game. So let's take note here. Good. Now, the dividend payment are included in administrative expenses in the trial balance. Wow. Is that right to do that? If you pay dividend, do you add it to admin expense? No. So what do? We have to calculate the dividend and take it off from admin and send it to a retained earnings in the changes in equity. Good. So to go to that section, then we are done. So all what you have to do is find the number of shares that will be in before and after the two dividends. Then we are done. Then you multiply it by the dividend per share to get the total value. Good. Now let's work it out fully and how to affect it. For the trial balance, you don't need to worry because the items over there, they are just debit and credit. So either it will be expense or it will be assets or liability or equity. But for the footnote, is the one that causing the issue. So first, there was a bonus issue of what? 144. So let's draw a nice normal line. The year financial year ends at where? 30th September. So the financial year will start from 1st October, right? So 2015 will start from 1st October. So as at 1st October, how many shares they have in issue? So let's go to the financial position. We can pick it from there. They have to tell us the number of shares. If not, they'll give us the nominal value of the shares so that we can multiply. So we can divide to get the number of shares. So go to, oh, the examiner is very good. Oh. How many shares? 500,000 ordinary shares. So basically, we go and pick that one. So at the start of the year, they have what? 500,000 OD shares. Along the line, match what? The date on March 2015. In fact, this will be 2014. Oh. This date is 1st October 2014. This is the whole year 2015 year. So around March 2015, they issue bonus shares. So bonus. Just like 144. 144. So how do you calculate the number of shares that came in as was bonus so that we can get the number of shares after the bonus issue or at the reporting period? So basically, 144. Don't worry yourself. Any conversion of the fraction that they'll give it to you, just convert it. The new one must come on top, the new shares that they are giving. The old or the existing shares must go down. That's all. So they are giving one new for every 4 existing. So that's what we mean by what? 144. So here to be, to get it by this one too, I'm explaining the issues in this. And then you try it. So I'll solve all the footnotes, but please, this one there, I just God beg you. Try and put all the footnotes together and prepare the financial statement. Balance it, forward it to me. I'll issue a full video on the solutions of at least 5 well-solved final accounts. Good. Now, so to be new, 1 out of 4 times the existing shares, 500,000. So how many shares came in as bonus? So therefore, 1 out of 4 times 500 will give us a quarter of 500 is 125, right? So 125 shares came in as what? As bonus. 125,000 shares. So therefore, what will be the number of shares outstanding at the year end or after the bonus? It will be 625,000 shares. Now let's see. When did they pay the dividend? But I can still use the old normal line. They paid 2 dividends. One was what? January 2015. So January 2015 will be somewhere here where the bonus shares have not been issued. So that dividend, so let's go and calculate the dividend. The third examiner that the dividend calculation, I'll do all the footnotes for you. or solve them, just that the financial statement preparation, I want to just prepare them. Good. So January dividend must based on what? The shares just before the bonus, which is the 500,000. So open a bracket, the 500,000 times the dividend per share, because by then the bonus shares have not been issued, so it will not qualify for what? For dividend. It must be valued at what? The dividend in, sorry, it must valued based on the shares in issue. So the share or the dividend value was 2.2. Here, in fact, if read three zeros, so you have to also read three zeros. So today times 2.2. Let me raise my three zeros. That will give us 11,000. I agreed. So that's 500 times 2.2. That's 11,000. Agreed. That's 500,000 times 2.2. We have read three zeros on top. So 500,000 times 2.2 give us what? Even 500,000 times 2. It's not 1 million. That's 10,000. Then the 0.22 give us another. So it's 11,000 basically. Good. 11,000. Then you relax for a while, then you come back again. Then you go to the next dividend. They pay another dividend again. Just that dividend will qualify, be valued on the outstanding shares. So they pay another one again, 2.6 on 30th June. So 2.6. So 30th June. So just write June. So June dividend will be what? Open your brackets. That one must be based on the 625,000 shares times 6.5. Okay, so it's 1,100, right? Okay, 1,100. I'll take that. Friends online, kindly confirm the figures like this. 1,100. Okay, I'll take that. Because 500 by 2 is 1,100. Great. Then the June, it was 6.5, right? So times 6.5, that will give us 1,600. 1,625, like this. That was the total dividend. So 2,725. Agreed. That's the total dividend. Agreed. So total dividend is 2.6, not 6.5. It's 2.6. So go 2.6. I've used the 2.6 to do the calculation, right? Great. Okay, so that's 1,300. I can see 1,300 here. 2.6 times 500. Answer. Yes. A 625, not 500. Okay. Okay, good. So times 625. Great. So putting the two together, get 2,625. So what do? What's the accounting treatment? So when you're preparing your financial statement fully, this is what I am expecting from you. First, go to your admin. Wherever you send admin, open your brackets. Bring the one in the trial balance, less 2,725. Good. from it. When you go to your retained earnings, that's first treatment. Second treatment, in your retained earnings, subtract 2725 as dividend. You are done. It ends there. So that's the end of the very first note. But don't forget the issues shares. This is the dividend section. Let's come to the bonus shares too. With the bonus shares, so the treatment of the bonus share, this is the dividend. Treatment of the bonus shares. Find the value. The value will be the number of shares. This is 125 shares. 125 with 3 zeros times the value of 10 cedis. So it will be 1,250. What's the accounting treatment? Now, when you issue shares, definitely your share capital will increase. So add this to the share capital on the change in equity. So add to share capital. So add to what? Share cap. So what's the other entry? To the same figure. Because here is a bonus, they use the company's own money to pay for that shares. So they sold to the existing shareholders for free or at no cost. So take it from where? Retained earnings. So subtract the same figure. So subtract from where? Your retained earnings. Call it bonus share. On the statement of what? Changes in equity. It will be horizontal, flat. Then you are done. Please, for this particular question, kindly finish your solution before next Monday. I'm begging you. The last one didn't receive the solution. Good. Now let's see. So we are done with the footnote 1 fully. Now let's go to note 2. Provision is to be made for a full year interest on loan. Yeah, the examiner should have taken it off to still be valid. Let's go to the trial balance. What's the loan note? The loan note is what? 8% loan note. 2012 to 2016, right? That they pick it from where? 2012, and it will be paid in when? 2016 financial year. But we are paying for 2015. So what's the value? 2,500, agreed. This means that you've taken or you've secured a facility or a loan of 8%. Loan of 2,500, you are paying interest at the rate of what? 8% every year. So calculate it for me. So 8% on what? On 2,500. That will give us, I like the answer. Let me go and pick the answer from here. That's 200, right? Perfect. So every year they have to pay 200. So in your profit and loss, the finance cost will be what? 200. Full one, whether they paid it or not, it will be 200. That's the finance cost. Great. I like the answer too. Now, then you check the trial balance. If you see any interest on loan notes, whether they add paid to it or not, that's what they paid during the year. So let's check. Let's count through. If there is loan note interest, so I'll check one after the other. There's loan note interest paid. This examiner is very good. Have you seen what is there? 110, right? So out of the 200, they've only paid. Please, whether this paid is there in the trial balance, have you seen the paid I've highlighted? Whether the pay is there or not, they've paid. Good. So that is it. So out of 200, they've paid only 100 and what? 10. So they are owing, right? They are owing an amount of 90 Ghana cedis or 90,000. So in short, in your P&L, 200 Ghana cedis must be shown as what? Finance cost. 200 Ghana cedis must be shown as what? Finance cost. So 200 will be shown as the finance cost in your P&L. When you go to the financial position, the balance sheet, go to your current liability. Tell the examiner that loan note interest owing. Open a bracket. 200 minus what? What they've paid. So therefore, they are owing 90. It ends there. How we get it? So the finance cost of 200. You add this to the other finance cost. If there are many in the question, we are done. So this one, I want to receive solution from everyone. That's why I'm actually solving the issues. You're not just reading it, you are solving it one after the other, just that it is letter form. So you're going to articulate everything, then I'll see. Good. Now let's move on to the next note. Now, note 3. The finance charge relating to the preference share equal dividend payable. In fact, both note 2 and 3, examiner could have eliminated it. It will still make sense, or it will still be valid. Yes, they have over fed us. Yes, they are giving us more than. So this one, even if these two notes are not there, they are still valid. In the same year, in fact, the same year, that's previous year, November 2016, this is November 2016, May 2016, in the financial accounting, examiner did the same thing. Good. So now let's go to the preference shares. These preference shares, how do you classify them? I can see 10% preference shares and I can see redeemable attached to it. So where will it be in changes in equity or the asset? I hope you know how I ask my questions. So without preference shares, would it be classified on the change in equity or the asset? Okay. So will it be okay to be classified as statement of changes in equity, right? It will be classified under what? Statement of changes in equity. Wow, I've done my thing again. But for renewal preference shares, they are not equity. It's not asset too. It's a liability. So it must be classified among what? The non-current liability. Any dividend paid on redeemer preference shares must be what? Must be classified among the finance costs. How do you get it? Good. So this one you classify it what? Non-current asset. Please, this solution, in fact, non-current liability, non-current asset. Please, in fact, this solution, the deadline is 24 hours. No, I've reduced it because we are solving everything. If you are solving everything, then exactly the deadline is 24 hours. If you send it after 24 hours, as soon as you send it, I will send it back. I will return it back again. I will send it back to you. So if you send it and I send it back, that means it was what? Rejected. Exactly. For every debit entry, there must be what? Corresponding credit entry. So I was just returning it. Good. Great. So within 24 hours, you have to produce the solution. Good. So redeemable preference shares, they are what? Liability. So 3,000 must be part of the non-current liability. Then any dividend paid on it is what? Finance cost. Because interest on liabilities are what? Finance cost. The interest on the preference shares is the dividend. So the dividend is what? 10% on what? The face value, because preference, they have a preferred right. So they pay them fixed amount. So 10% on 3,000 is what? 300. Good. So that 300 must be what? Be part of the finance cost. So right now, if I should end here, the finance cost that we have come across is what? There are two so far. They are not done. The finance costs are two. The loan note, which is 200, then the preference shares, which is what? 300, right? We are not done. So far. So that when you are going through, you'll be fine. Please. Okay. Now let's continue the game. Now this dividend, have they paid? If they are paid, you see it in the trial balance. So let's check. If you see preference dividend on the trial balance, that means they've paid. If they have not paid, that means they are owing. I can see so they've not paid. So that one too, they are doing what? They are owing. When you go to your financial position, the current liability, tell the examiner, preference dividend owing. How many? 300 Ghana cedis. You are done. How big get it? So note, that note too is also what? Cleared. So note by note by note. We will solve everything. I want to see if to give you the solution, and probably put it together. Now let's continue the game. Note 4, non-current assets. So Quadaso Limited. Depreciation of PPE is to be provided on the following basis. Plant and equipment, 10% on what? Cost. So how do you calculate the depreciation? You find 10% of the cost. So let's go and look for the cost of the plant. The cost of the plant. Cost of the plant in a trial balance is what? Plant. Cost and depreciation. So the first one is what? The cost. The second one is what? The accumulated depreciation. So the cost is 13,750. So 10% of it is what? 13,750. And that will be the depreciation charge on the plant for the year. I hope you get that. Good. Perfect. So now let's move on to the next asset. So the next one, computer equipment, 25% on cost. So that one too, you find 25% if there's no any other information. The motor vehicles, engine, 20% on reducing balance. So that means you go and find the carrying amount. So motor vehicle, the cost is what? 1,500. The accumulated depreciation is 400. So you subtract, then you get a carrying amount of 1,100. Then you strike the 20% on 1,100. That will give us 200 and what? 20. Then you are done. Have you seen? So quite also, it's a very good question. Now let's move on to the next item. Now we are saying that no depreciation has yet been charged on any non-current asset for the year ended 30th September. Now let's go to the next note. Okay, information reaching me suggests that we should close early so that you can have time to solve, because the deadline is what? 24 hours. After you solve it, I will release the step-by-step full solution of it. Then you are fine. Good. Then the next note states that Quadaso Limited revalues its building at the end of what? Each accounting year. So at 30th September 2015, the relevant value to be incorporated in a financial statement is what? 14,100. So that is what? The fair value of what? The building at the end of the reporting period. So that means depreciation will be based on the figure in a trial balance. So let's go to a trial balance, but let's continue. It says something nice here. The building, the building's remaining life at the beginning of the current year, that's October 2014, was what? 25 years. Good. Quadassu does not make an annual transfer from the revaluation reserve to retained earnings in respect of what? Realization of the revaluation surplus. That's the excess what? Depreciation, transfer of excess depreciation. If the company does not transfer, if they do, what do we do? We are going to transfer it from where? The revaluation reserve to that of valuation reserve to that of the retained earnings to reduce the excess depreciation. Now, the life of the building is 25 years. The life of the building is 25 years. So let's go to the trial balance to pick the building value. Good. Let's go to the trial balance to pick the building value. Good. So the building value is what? Building, why are you? Okay, yourself. Oh. Building, why are you? Building, where are you? Okay, building. Leasehold building at valuation 14,000. Have you seen that one? There's no what? Accumulated depreciation because they just did a valuation last year. Uh-huh. Good. So 14,000 depreciation based on the 14,000. Now, take note of this. This one too, let me solve. Anytime there's revaluation in a question, please, there are three steps. Step one, step two. In the final account, three steps. Step one, check where the valuation was performed. Other than that, you do empty calculation with no mark. Whether the valuation was performed at the end of the year or at the start of the year. First, so there will be two, either at the start or at the end. So I'll provide. So one, if the valuation is performed at the end, then how do you charge depreciation? Like this question. Evaluation is performed here. They did a valuation here. Oh, then don't worry. Then depreciation must be based on the asset value at the start of the year, right? But this asset value will travel. Come. When it enter the last year or the last month or the last day, then they change the value. So depreciation must be based on this. So if the valuation is performed at the end of the year, depreciation must based on what? Based on the item in the trial balance, the figure in the trial balance. This figure will be the trial balance for you. So it must be based on the original cost, the original amount or the original cost. That's all. Second, what is the depreciation based on what? So the revaluation was done at the start of the year. Wow. At the start, right at the beginning of the year, no, they changed asset name. So originally the asset was bought 20 years ago at a cost of 20,000. But beginning of the year, they did a valuation and then a qualified and independent valuer placed a value of what? 15,000 on the asset. So it means that Now, if the valuation is being performed at the start of the year, then the depreciation charge for that year must be based on what? A new amount. That's the fair value. How we get it? So if it's at the start of the year, then depreciation must what? Be based on depreciation is based on the fair value or the revalued amount. Take note. Other than the depreciation calculation, you may get it wrong another if the valuation is in the question. This is final account. So this, what will be the depreciation? Yeah, I'll do all the calculation. So here, the valuation was performed when? At the end. So if it's at the end, then depreciation must be based on the original figure. It will be given to you in a trial balance. This figure will be given to you in a footnote. The fair value is always in the footnote. So let's go and calculate depreciation on the building. For depreciation, for the other one, we've calculated them. So I'm doing the building. So depreciation and right building. And you know where depreciation will be charged to? Open your brackets. We said that depreciation, the evaluation is being performed at the end. It must be based on the original figure, which is 14,000 and trial balance. And the examiner told us that at the start of the asset year or at the start of this year, the building has 25 years to go. So the depreciation will be 14,000 over 25. That will give us 560. Good. I'm done. Now let's go and calculate what? Revaluation gain or loss. Now that one too, that's a step 2. Calculate the revaluation gain or loss. That calculation too also depend on the step 1. Step 1 say determine whether the evaluation was done at the end or at the start. So that depreciation will based on you select. Now when you go to step 2 too, the answer is based on this. So it tells you that this guy is very stubborn. So step 2, calculate the revaluation gain or loss. Revaluation gain or loss. So let's see. So step 2, calculation of the revaluation gain or loss. So let's calculate it. Revaluation gain or loss. So revaluation gain or loss. We said that with revaluation gain, two items. What are they? The revalued amount, which always is in the footnote, less what? The carrying amount, C. So let's go and pick the revalued amount from the question. Then we are done. So revalued amount, the asset was revalued 14,100. That's 14.1 million. So 14,100. So even if I cannot do anything in the question, please, not this 40,100. If you do something like this, leave it. One tick for you. Good. Carrying amount of the assets. How do you get the carrying amount? Here, evaluation was done. Again, to get the carrying amount, if the valuation was done at the end of the year, if the valuation was done where? At the end of the year, now when the carrying amount is, what do I do? Have to do is that take the asset original cost and subtract all accumulated depreciation. That is the one on the trial balance. Sometimes there will be one on the trial balance plus they charge for the year. What you charge from year to year, they charge for the year. Good. That's it. So if the valuation is being performed at the end of the year, you want the carrying amount at the end. So what do? You bring the cost of the assets. What's the cost of the assets? 14,000. The original cost is 14. Less all depreciation charge as at the end of the year, which include what they've charged previously. That's the open balance to be in the trial balance. Always the open balance is in the trial balance. So let me put trial balance here, TB. So the open balance is the trial balance. And what you charge for the year. In this question, let's go and see if there's what accumulated depreciation on the building. Because they said they use the word valuation. I doubt there will be depreciation on building. Got to use the word valuation there. It won't give you. So there's no accumulated depreciation. Good. So that means the opening balance of the accumulated depreciation is 0 plus the charge for the year. What they charge for the year is a 560. So finally, it means that we only lessen the 560 from it. And what will be the answer? Good. So carrying amount will be if at 14,000, let me squeeze it, less 560, 13,440. So is there any gain or loss? So there's revaluation or gain agreed. Or the revaluation gain? Friends online. The revaluation gain. Valuation gain of what? So 660. Now that's the step 2. Step 3, accounting treatment. That's all. So now there's a gain of 660. How do you treat it? So revaluation surplus on the OCI. So first, we have already added to the asset account. First, when you go to your PPE schedule, and then please, I'll inspect that. When you go to PPE schedule, we said that add again to the asset carrying amount. If I add it to this, it will just be 14,100. So the building, I'll state it at 14,100. We are done. That's workings 1. Workings number 2, or accounting treatment 2. Add the gain to what? The OCI. So send it to OCI. Valuation gain. And send it to what? Revaluate. Changes in equity. Send it there too. Then we are done. So I'm done with the revaluation gain or loss. We are done. Now let's move on with the game. I like this very question. Okay. Now the next note. But if you do have any questions, suggestions, kindly let me know. Kindly let me know. Good. So there's a question here for us. Gain or loss. Great. So basically, that is that. Now let's move on. Next note. We'll actually solve all the notes so that when you are preparing it, it will be a bit easier for you. Now we are done with this note. Let's go to note 5, and I like note 5 because we are done with it. That's financial instrument. The available for sale instrument held available for sale investments. So that's instrument there. The available for sale investment held at the 30th September 2015 had a fair value of Ghana cedi of 8.4 million. There were no acquisition or disposal of this value during the year. That's all. So how do you treat fair value? So how do you treat available for sale investment? How do you treat it in the books? Here, all you have to do is you compare the fair value changes, right? Whether there's been an increment in the fair value. If there's any change, where do you report it to? Where do you report the changes? Okay, there are 3 important measurement bases in financial instruments. We said held for sale, held for trading, and then held toward maturity. All of them have a specific treatment. Good. So if it is held for trading, changes in fair value goes to where? Goes to the P&L because that's your main target. Your main target is the trading. You are going to gamble with that instrument. Good. So that is it. Then, if it is held for sale, changes go to where? OCI, because you are not interested in the changes in the value. What you're interested in, somebody should come and buy the thing and take your money. It's not the value. That value, you've not realized it. And so the person come and then what? Actually acquire it at that high value before you make that realization. So basically compare. So how do you get a value? So let's go to the trial balance. You can see available for sale instruments. Just saying the instrument there. Available for sale investment 8,700, right? Good. 8,700. If you go down there, if you go, what is the fair value now? 8,400. So is there any fair value gain or loss? So there's a fair value loss of what? 300. And this 300 must be reported in where? OCI. So in short, if I should end here, our OCI will be what? Something like this. The OCI, there's revaluation gain of 660 going to OCI. So this is how I want the OCI section to look like when I print this financial statement for me. So let us know this is the profit after tax so much. You write OCI as big as this. Revaluation gain 660. Then fair value loss on available for sale, which is what? 300. Put it in brackets. Then put all together, get total comprehensive income so much. That is how we want it. This one show workings for me, okay? The fair value gain, yes, very important. But fair value loss, bracket 8,700 less what? 8,400. Show the gain for us. Show the workings. Good. Then you are done. Great. If we should, and yeah, this will be the comprehensive income. Now let's continue the game. The game is getting interesting. When you go to the financial position, what will be the value? Then you pick what? The closing value of what? 8,400. Send that one to the financial position. So when you are listing your non-current assets, great. So that is it. So we are done with the note 5. Now let's go to note 6. Let's go to note 6. Let's go to note 6. In this question, there's no note that you cannot try. So let's see. Note 6 to we've done it. I like that note. And this note has been one of our major questions. In February 2015, Kwadaso Internal Audit Unit discovered a fraud committed by the company's credit manager who did not return from foreign business trip. He hid. After they went for the trip, he didn't come back again. Okay. The outcome of the fraud is that 500,000 of the company's trade receivable had been stolen by the credit manager and are not recoverable. No insurance. So 500,000. There was a certain year they used 400,000. So I think you will meet it in the list of the question that forwarded to you. Now, of this amount, 200,000 relate to what? The year ended 30th September 2014. That's last year, right? That become what? Trial period what? Errors. IS 8. I like that. So how do you correct the error? IS 8. So 200 must be sent to what? The changes in equity, the retained earnings column only. You have to adjust the open balance of the retained earnings to get what? To get restricted open balance. Good. So that is it. Then, good. Just okay. Now let's continue the game. So let me dash the board for that one. That one is a very different game altogether. It's a different game altogether. Different game altogether. So this is the issue. We discovered that 500 Ghana cedis is missing. This one is from last year. So last year 200 Ghana. So that means this year will be what? 300 Ghana. Agreed. My interest is how you treat this guy. This one. That's IS8. Mm. So that's IS8. The current one is so straightforward. Add it to your operating expenses. Add this 300 to operating expense because an expense to you is a bad debt which must be written off. But this 200, you cannot add it to this year's operating expense. Why? Because it's not for this year, it does not occur this year. No, for last year. So what do? So your changes in equity that I want to prepare, let me know this changes in equity that I want to prepare for me. There will be a section called retained earnings or income surplus. So retained earnings. All you have to do is this. That column alone, you bring the opening balance. So much. So let me go to trial balance and bring it because I said I will solve it. Let's go to the trial balance and bring the opening balance of the retained earnings. That's 3,600, right? So here is it. 3,600. So that's I'll put it here. So I'll put it on you. 3,600. Go ahead and place it. Retained earnings must come here. 3,600. Tell the examiner that error. Mistake. Someone took 200 Ghana from last year's figure. So I'll take it off. I'll get what? 3,400, right? Call this one restated open balance. We've done the retrospective restatement. Then we are done. Go. So restated open balance. Then when you go to admin or the operating expenses, you add. So add the current year's own, which is 300, right? Good. Then finally, the total amount is subtracted from the trade receivable in the financial position. When you go to the financial position, so financial position, you write trade receivable, open a bracket, whatever is there, less 500 from it. But that 500, they can't receive it. That credit manager, yes, add it to operating expenses. So that will be the treatment for that note, and then you are done. Good. You have to either administration expenses or the operating costs. Good. So that is it. You add it to the operating costs. So basically, that's a note 6. That's a note 6. Portion of it is IS8. I like this style. I like this style. Now let's move on to the last footnote that we are done. The last footnote states that Father One, yes, they've informed me that these footnotes target members are very good at it. So here too, they will tell me. So join us. Good. Corporate income tax payable estimated on profit for the year 3,500. An amount of 1,200 is to be transferred to the deferred tax account. I like that. So here to start work because here they've informed me that tell me what to go to the P&L as tax, what to go to the financial position. Because they have informed me that you are very good when it comes to income tax. IS 12. So let me pick your answer. Great. So if your answer is ready, let me know. Let me go to the trial. Let me go to the trial balance. Let me go to the trial balance. If I can see the deferred tax there. Wow, is there? I can see the deferred tax there. Wow. The opening balance is what? 2,300. Okay. And let's see. This is the last footnote to try and score some more. Yes. Good. So let me touch the board again for this particular footnote. Please watch the video from start to end. No shortcut. No pausing. No forwarding. This very one. I will release it. Is it? Okay. Good. Let's continue the game. Now, with the tax, all what I did is tell me the C, U, or O, and then the D. Then, at the end of the day, also tell me the deferred tax account. So, with the deferred tax account, tell me opening balance. So much. Tell me closing balance. So much. Then tell me final figures. We are done. Any figure for me? Okay. I thought the target members. Okay. You have answered it right. Okay. Now let's see. First. Okay. First answer received. I like that. First answer received. I hope you know the game right. Okay. Balance sheet. Fact. I like that too. I like that. I hope you know the game right. Any answer is valid. Any answer, good. I like this answer. Now let's see. Very perfect. Now the question is the corporate income tax payable estimated on profit the year 3,500. So that's the profit. The tax provision on profit, right, for the year. So C, current year tax 3,500. Have you seen? Yeah, they didn't tell me under and over. So let me go to the trial balance and see if there's any under over there. Because it can sometimes be bad. So tax, no. So that's all. So no under over. So even if you have written it already, just put that there. In the question. Don't worry yourself canceling it. Deferred tax. They said something there. I like what the examiner did. Let me go and pick the opening balance first. And today, have you seen this one is different from the one that we just solved. And then to also be different. That's why we have to solve 5 questions before we see for the exam. So if we depend on one question, that's not professional exams. One question cannot guarantee your success. Only 5 questions. 5 different, not the same question 5 times. No, 5 different questions. I hope you remember the one of the target principle that states that one known is not equal to one unknown, but 5 known now is equal to what? One unknown. Thank you. 5 questions. That's the principle. So like P&L, sit down, solve 5 questions, not the one we solve here. Not the one we've solved, you use that one as a guide. Solve 5 questions, don't watch the solution, and see if you're able to get them, then write the paper. If you're able to get them, don't until you get them. Good. 5, 5, 5, 5, 5. That one, when you go, you'll be fine. Good. So let me go and pick the open balance. I will just by the roadside though. Good. The open balance of the deferred tax was given to us of, if we see deferred tax balance, for they said it's 1st October 2014, that's the open balance. 2,300, right? Agreed. So that's 2,300. So that's the open balance. The open balance is 2,300. So I come here and come and write 2,300 come from the trial balance. Coming from the trial balance. Then I'll go to the footnote and go and then continue the game. I'll go to the footnote and go and then continue the game. Now the footnote states that here they're supposed to give us the temporal difference that we multiply by the tax rate, right? Yeah, no tax rate, so you can't do anything. So what do? An amount of 1,200 is to be transferred to the fair tax account. We said that the amount that we will record over here is the movement, the difference between the opening balance and the closing balance, and that's the transfer. We always transfer that one to the P&L because we transferred from here there. So that means in this question, they've already given you what to go to the P&L to be 1,200. I can record it here, 1,200. We are done. Sum all this one up, you get 4,700. Perfect. Sum all this one up to get a closing balance. That'll give us 3,500. Good. So therefore, we are done. So send this one to the P&L, taking this one to P&L, sending this, the closing balance must go there as what? Non-current liability rate. And then the current year tax provision, this one goes there as what? Current liability. We are done. So, yes, I said that they had it correct. That's target member. They had it what? Correct. Target members, they had it correct. Good. So that is the game. Non-current liability, current liability, taking this on the P&L as an expense. We are done. Now let's read the trial balance. We are done with everything. We've actually solved the issues in the trial balance. So if your balance sheet does not balance, don't send it. Okay. Yes. Now let's come to the trial balance. Let's see the usual and unusual item. We are using RAT or RAF. So let's go. Now sales revenue, we are aware of it. Inventory, there's cost of sales. That inventory is the closing balance. Great. There's selling and distribution expenses, admin, loan note interest. We've talked about that. Bank interest, where will it go? Bank interest is what? Finance cost. Great. Now let's move on. Investment income, where will it go? 360. Other income. Perfect. Leasehold building, we've done that. Plant, we touched all of them. Motor vehicles, we touched. Allowed for sale, we touched. Trade receivable, nowhere to go. Then bank, have you seen this bank? This one there is very troublesome. Have you seen this bank overdraft? It's a liability. Have you seen, you didn't add overdraft to it too? Because if you add overdraft, you say that overdraft is a liability. You just write bank, but look at the balance. It's 910, but it's at credit. So you go to a current liability. Perfect. So add it to your current liabilities. Bank overdraft. Perfect. So trade payables, no note to affect it. So just carry the deferred tax. Talk about that. Just we talk about that. Ordinary share, we talk about 8% loan note. Yep. 10% preference share. Yes. Revaluation surplus. You add to go to change in equity, general reserve, retained earnings, And that is the end of today's section. Thank you very much. The inventory in a trial balance represents closing inventory. If there's cost of sales in a trial balance, then the inventory figure represents what? Closing inventory. That is it. Then we are done for today's section. Please, if you do have any question, kindly ask before we close the chapter of the day. Please, let me repeat this. The assignment is 24 hours. Within 24 hours, starting from now, let me check the time that we are ending. I'm assuming we're ending 9. So 9 p.m. up to tomorrow 9 p.m. If I don't receive it up to tomorrow 9 p.m., if you send it, it will be rejected and sent back to you. That means even though I'll take it and go through, I'll send some also to you. So please try. This one, we've actually solved it, just that we've not arranged it. So you are going to now arrange it for me, and then we are done. So thank you very much for coming. Don't forget to subscribe. I've not done that.